What's up, guys? My name is Robert Kale. I'm a partner and business broker at businessexits.com. Today, I'm going to go through a common question from sellers. They want to know, what do offers actually look like from buyers? Is it all cash? What do deal structures look like? We're going to go through all of that right now. All right, so first let's go through the most common deal structure types. You've got all cash, which is obviously what all sellers prefer. 100% cash, you walk away. That's the ideal scenario. It happens, we have all cash offers on some of our deals, but it's less common. More common is a combination of cash and seller note or cash and earnouts. And I'll go through what each of those means. So for example, seller notes are payment installments after closing with interest over time. So you've got mostly cash at closing, but you've got a piece of the deal that's paid in the form of a seller note. So the buyer is going to pay you, for example, 10% of the overall deal over 3 years, paid annually. In arrears means at the end of that year. So each year, at the end of the year, they'll give you a payment with 7% interest on that entire note. So let's say your deal is $5 million in total, 10% of the deal is a seller note. So you've got $500K of that deal as a note paid over time with interest. So $4.5 million cash at closing, $500K as a seller note paid over time. Earnouts, on the other hand, are kind of the same thing, payments over time, but they don't have interest and they're tied to the performance of the business. So it's often tied to a revenue benchmark or a net profit benchmark. This is really negotiable between the buyer and the seller. And as the broker, we help you negotiate this part if the buyer wants to do an earnout. Obviously, it has to make sense for the seller to accept this. It's not preferable for the seller or for us as the broker to accept these kind of offers because the buyer has the business, right? They're running the business. How can you trust them to run it well? So therefore, the seller gets paid in this earnout. It takes a lot of trust between the two parties to make this work. So after the sale, the buyer is supposed to pay the seller payments tied to that performance of the business that they now own. So for that to make sense, it's got to be an enticing deal structure and terms for the seller to accept this. So it's got to be, a minority part of the deal as an earnout. You have to have faith in the buyer to be a strong operator of your business. Obviously, we've met the buyer at this point and spoken to them, so we have a sense of who they are, what business they've run in the past, their background, and how much confidence we have in them to run your business. But getting back to what an earnout looks like, again, let's take that 500K as an earnout example. Each year, for this example, let's say they pay it out over 2 years, they'll pay you a total of 500K broken up in 2 years, so 250 and 250. So if the business revenue exceeds the current 5 million revenue benchmark, they'll pay you that 250K after year 1 post-closing. Again, same thing in year 2. If the second year exceeds 5 million revenue, they'll pay you that second 250K. Now, if it falls short, this is a part that a lot of sellers don't quite understand until I explain it. So if it falls short of that goal, you're still paid on the performance achievement of that goal. So you're not losing that 250K outright. You might be paid a percentage of that goal achievement. So if the goal was 250K paid on the 5 million revenue, you might hit 80% of that if the buyer doesn't operate the business well and it falls short for whatever reason. You still get that achievement. So if it hits 4 million instead of 5 million revenue, that's 80% of 5 million. So you get 80% of 250K, which is 200K. So it's a dollar for dollar discount based on the achievement of that goal, if that makes sense. So most of our deals are doing seller notes, I would guess. Some of them do earnouts if we can come to an agreement on the negotiation there. If the buyer is going through the SBA 7A loan process with a bank to acquire your business, which a lot of our buyers do, it's a great government loan program. It allows the buyer to put down 10% to acquire a business and then leverage the loan and pay that loan off with the bank over 10 years to pay off for the business. As the seller, you get most of that cash at closing from the bank. So you usually get 90% in cash at closing from the SBA loan, but then you get 10% is usually what banks require to, oh, I can't go backwards in my slides, but usually the SBA loan requires 10% seller note as well, so that the seller has skin in the game and the cash is more spread out for the buyer as far as their cash flow. So banks usually require 10% down from the buyer, 10% seller note from the seller, and then they'll cover 80% of the rest of the deal as the loan through the government. So just heads up, if you do an SBA loan with the buyer, the bank is probably going to require that 10% seller note from you. Terms are a little bit negotiable, depends on the cash flow that the buyer is looking at post-closing, but expect a 10% seller note. So let's look at an offer example. Let's do that purchase price of $5 million. Cash at closing is $4.5 million. Seller note of $500K paid over 3 years. Again, annually paid in arrears means at the end of year 1, at the end of year 2, at the end of year 3, and 7% interest rate. As far as interest rates, we usually see anywhere from 5 to 8% interest. Right now it's 2022, there's inflation, which is really high, so sellers want a little bit more interest to make it make sense for them to fight that inflation. But anywhere 5 to 8% is pretty standard. Other terms to know in the offer letters: as a first-time seller, you'll come across a lot of terms from especially private equity companies who are very savvy with buying businesses that might scare you at first. And this is again where a broker comes in handy to help you understand the terms and negotiate against them and understand what you're fighting here. But you've got working capital peg, which probably deserves a whole new video on its own. Stock versus asset sale and indemnification escrow. So I'll go quickly through these. Each of these probably, is a deeper dive into a separate conversation, but brief overview: working capital peg is, how do I even sum this up quickly? It's a calculation that's used to protect both the buyer and the seller if it's done right. Now, if the buyer is a shark and you're not protecting yourself on the seller side, the buyer could use this to take advantage of you. So you got to be really careful with this part. It's basically looking at your balance sheet as the seller, your accounts receivables, accounts payables, inventory, any debts or assets you have coming into you, and we're netting those out to arrive at a peg or a number that we calculate. So if you have 200K in AR, you got 100K in AP, let's say that's all you have on your balance sheet, and that's the average for the past 12 months of the business. If that's the average, and you could say, okay, every month you've got 200K AR, 100K in AP, the net of that is 100K as our peg number. So the point of this is when you sign an LOI, you've got this peg, you say, okay, that should net out to 100K. If that changes by the time we get to closing, if the seller stops paying their bills and all of a sudden AP creeps up and AP is 200K, that net goes to 0, then the buyer has to be compensated for that, because when the buyer comes into your business on day 1, they have all these bills to pay, right? So that's the protection for the buyer side. For the seller side, it works in the opposite way. If you've got accounts receivable at 200K and then that jumps up to 350K and you get to closing, the seller is going to say, well, wait a minute, that's my money, right? I earned that money. I should be compensated for that. So then the buyer compensates the seller for that increase in AR if AP stays the same. So if AR goes up to 350 and your AP stays at 100, that nets out to 250. So that difference should be paid to the seller at closing as part of the price. That's the basic summary. That's the best I could do in a quick nutshell. Again, there's other parts of it, but that's the basic idea of it. So if you see that in your offer letter, talk to your broker, make sure you're calculating it correctly. The buyer's not trying to pull anything over on you. It's a major point of contention for first-time sellers because it's a whole new concept. And for experienced buyers, hopefully, I like to believe they put it in for protection for both sides, but in some cases they can try to take advantage of you as a seller. So work with your broker on that part. Stock versus asset sale. Let's go to that really quickly. So stock sale is, for most deals under 10 million, it's only done if there's a tax advantage or if there's contracts tied to the entity of the business, or some reason like that. Most deals, at least for small businesses, are asset sales. That means that the buyer is not buying your entity, so they're not buying your LLC, they're not inheriting your bank accounts or your cash in your bank account. An asset sale is much cleaner for both parties. For the buyer, they don't want to inherit your liability a lot of times, so an asset sale is cleaner for them. They can set up their own entity in whatever state they want and buy the assets of your business and transfer them to their entity and start a whole new slate clean as far as liabilities. For the seller, an asset sale is a lot easier. It's also a lot easier for the legal process during closing. Now, talk to your CPA as a seller. Understand if a stock or asset sale have different implications for you as far as taxes. If your CPA says that a stock sale is going to benefit you more, we can pursue that with the buyer. And then there's also a 338 election that we can do on the buyer side that is a stock sale that treats it like an asset sale. It's more technical. Again, work with your broker on closing on that. So at closing, I mean, you work with your broker the whole process up until closing, and then you've got your attorney and your broker, and then you ask your CPA some advice for things like stock versus asset sale. So work with all of your team to, make the right decisions for you at closing, and then the broker works with escrow to make sure you get paid and close the deal. The last one, indemnification escrow. Again, a fancy term that a lot of private equity groups use and know how to use in acquiring a business. The basic idea is that, again, I've only seen it in stock sales. So this is a protection for the buyer if they do a stock sale on your business and they acquire your business with a lot of liabilities on it. You've got 10 years of history on your business. Let's say the buyer comes in and buys your business, buys your entity. For the buyer, they might ask for some money to be put into this indemnification escrow so that for the 12 months post-closing, if anything pops up that is really a liability from the previous owner, that cash is taken out of that escrow account and doesn't ding the buyer for that penalty, whatever it is. An example might be taxes. Let's say the seller failed to pay some tax bill and the buyer was made aware of it 6 months post-closing. And they're like, crap, now I got this tax bill that the previous owner didn't pay, and I got to pay out of my pocket. That's not fair. So that's why this is set up to protect the buyer. Some of the cash of the purchase price is put into this indemnification escrow. And then if anything pops up in those 12 months, it's pulled out of that account. And after those 12 months expire, that cash goes to the seller and you're paid on that. So it's just a safety account for the buyer. It might be locked up for 12 months. Sometimes they ask for 24 months. Again, work with your broker to work on these terms with the buyer, but that's what that is, just so you know what it is when you see it in the offer letter. That's it for today. Just wanted to go through offer terms, seller notes, earnouts. Any questions, drop them in the comments. Anything else you want to see, let me know. We'll do another video. That's it for today.